kind of the goal is to, I have a real estate investor client of mine that has like 5 million of term, and finally he's ready to convert / he's open to he's open to doing another medical exam so I can kind of structure the policy however I want. But he is I thought this would be interesting because he's he's open about it. He's very ADD, as in like I have him for 15 minutes. That's all he can talk about, this kind of stuff, before his brain starts to wander, right? So it's important that I structure the conversation and structure the email. He kind of knows what he wants, right? But he's like, hey, give me the summary. Give me like a 15-minute summary, and then he'll ask questions, right? So it's like, okay, I have to have the design, right, on top of that, so he can quickly and easily look at it. The guy's worth quite a bit of money. He knows, he's certainly above average intelligence from that standpoint. So then it's a matter of taking that information and then like summarizing it and being like, hey, like, here's all the different ways that you can use it. Here's the way that I think you'll use it first, which we'll talk about, and kind of making it like almost like my goal is to, hey, read all this stuff really fast. It's going to take you 5 minutes, right? And then watch this video that I'm going to film for him. That's 10 minutes, 15 minutes total. And then that way, when I have the meeting with him, I can answer all of his questions and then have another 15 minutes. So that's kind of like the goal when you're dealing with somebody, to keep things at a high level but still simplify. So that's kind of what we're going to do today. So I'm going to show you guys how I would write that email, the policy design, so on and so forth. So any questions, thoughts, or comments? So let me pull up his age here. And I got referred to him by his brother like a long time ago. So that's how I got him. I'm going to start with Lafayette just because I think they're the easiest illustration to, number one, walk a client through. This is not who his term insurance is with. His term insurance is actually with not even a mutual company. So I already laid the groundwork that he's going to have to do new blood work in order to get approved. He actually used to be in the marijuana industry, as in he owned a bunch of marijuana farms, and therefore it was very difficult to get him approved 4 or 5 years ago. Since then, he's sold those businesses, so we can a little easier now to navigate that.
I have a question about that. Mm-hmm. The odds of somebody being in that business and not smoking is one thing, but
it has nothing to do with smoking or being in the business. It's the fact that a lot of banks,
federal,
it's hard to track whether it's money from a legitimate business versus the illegitimate business. And because it's federally not approved, the insurance companies are very questionable on taking funds from that space.
Okay.
So ultimately, this guy has he's got I'll say he's got 1.5 million that he has sitting in cash that he's like, all right, what would you do? His goal was to use a million of it to purchase his house, to build his brand new house. He's moving from Oregon to upstate New York in about 6 months. So he's got that. So my goal is to show him what it would look like using this policy. Maybe not for 100% of his house, but for a good chunk of the construction of his house that he could pay back. Show him why that would be better than paying a mortgage. That's the goal. So let's talk through that. So I'm going to show kind of like starting from scratch here. $60,000 a year. Let's keep it easy. Let's say $50,000 a year. I'm going to say 60 base, 40 PUA. I'm going to show 10-year term. We're going to show a lump sum of $700,000. And that's going to include the first 50, or no, let's say 750, and that includes the first 50. And then we are going to also show a reduced paid up in year 10. And let's see what that looks like first. I'm waiting on one email for okay, so that term did not like that term. So it's meching right now because of the term. And so let's see how much term. So like one way to see how close you are is you can always go to this term section, right? And it's adding 7.5 million of term. So if you quickly just kind of do the 7540260 divided by 628,355. So I'm slightly over the 12x. Like, so the term is, so I'm very close to getting it to work from a not mech standpoint. So I'm going to just do it just to make it easy. I'm just going to do 60,000. And I think that should work. And I'm also going to change it to a 7-year term to drive the term cost down. So when we have 7-year term, 7-year. So let's see if that works. Calculate here. Okay, so see, now it doesn't make. Okay, so 750 for 7 years. 705 divided by 750. So we're at like 90. Can't get any higher than that from a cash value standpoint. So you can see right here, he's got this, pays it for 10 years, and then he's done. Okay? So this is like a pretty good starting point. Okay, so now, minimize that. Any questions so far? So like, can't get any more efficient than that. What I may end up doing is showing, so he's got 750. He said it's going to cost him $1 million. So we're taking half. So he needs to take 500 grand out. No, he needs to take. Well, let's show him 500. He's going to take 500 grand there. He's going to. I'm going to say that he's going to repay that loan interest annually. Okay? And so now we are going to run this. Okay, so, and for those that are somewhat new, you cannot show a loan in the first policy year because they don't know whether or not this 750 is coming in right away, or at the end in month 12, right before the next policy anniversary date. So he can take this loan in the first year, but he can't illustrate it that way. You can illustrate it that way after the policy's in force. Okay, so here you can see that $35,000 a year of interest, right? Which is high, which I've been meaning to call them again and ask when they're lowering it. It was supposed to be lowered. 30 divided by. I'm going to email them right now. Send me the updated loan interest. It's supposed to drop back down to 5.5, which is more realistic. So at that indication, 500,000, 95.5% would be 27.5, right? So it's a pretty good savings. So the concept still works. So we'll go through the concept, and then it's a matter of, like, again, I'm not tied to Lafayette. I might look at Emeritus. If he's already selling his house, I might have to go to Guardian or Mass because of New York. So there's just a lot. Emeritus also has their product in New York. So just kind of keep that in mind of, like, again, I'm not tied to this, but it's the easiest illustration to run to give me a baseline. So taking 500,000 and he still has 750. So again, what we're going to show him is, that was from last week. Save. I think this is the right one. Yeah. Okay. So we're going to show mortgage rates are still at around like 7%, I think. Okay, so $500,000 loan, annual interest rate of 7%, term length 30. His monthly payment is that. Probably be like at least homeowners insurance, right? So P&I will be 0. So his mortgage is $3,300 a month under this example. So let's say he has minimize this. Okay, so you have savings account. Being the bank, it's been a while since I've looked at my things here. Okay, so if he has $1.5 million in the bank, okay, and let's just say he's only earning like 4% right now. Again, it's fully liquid. Zero contribution, and then right here we take minus 500,000. Okay, so he's still earning 4%, and now we're going to put the same. Let me think about this 1 second. Let's do this. 500,000. He takes 500,000 out, earning 4%, and now he's saving just this mortgage of 3326 times 12. And I'll go through this with everybody. Okay, so all I'm doing right now. Okay, so let's walk through option 1. Option 1 is he finances this house for $500,000. Okay. He finances the house for $500,000. He pays $3,326 into a month, right? And so in 30 years, he's going to pay 1.197 in total payments. He's going to pay $700,000 in interest, $697,000. Okay, so his total payments is 1.197. Okay, so that's option one. Option two, right, is he pays $500,000. Right, he pays cash for the house, and then he takes the same contributions as the mortgage, right? And I'm just talking about the mortgage because he's still going to have to pay property tax and insurance. And if he does that for 30 years, right? Let's drag this down, run, and we do this. You can see that he's at $2.3 million. Okay. So in this example, though, he still has $500,000 that's been earning zero. But just so everyone's on the same page and what I actually need to do, sorry. So the other option is he finances it, right? But he still has $500,000 that's earning 4%. Where does that put him in retrospect, right? Now, obviously, he can earn more than 4%. Those are variables that I can, discuss with him for sure. But you can see how being the bank, right, and paying cash puts you $600,000 ahead. Does everybody see that? By just letting this money sit here and earn only 4%, it's way better to let this money, to pay cash for the house and then put that money into this account and let it grow. Okay. Everybody with me so far? I'm just going through pure math right now. Because on top of this, you get some deductions and you can get some other things, but you're still paying $1.2 million in payments. So it's kind of you're only getting $175,000 in tax credits or tax returned dollars. So everybody with me so far?
So with this,
yes, no.
I know you deposited $750, so he's got $250 compounding also, isn't he?
Oh yeah, that's true. That's a good point. Sorry, let me $750 here, $750,000 and $750,000. So yeah,
okay. All right.
Yeah, sorry, good catch. So now we know that, okay, this is still better, right? The paying cash for the house is better than financing the house. Makes sense, right? Everybody can kind of agree, all right, the numbers line up there, that makes sense. I'm paying these monthly payments to myself versus paying it to a bank that's charging me interest. Okay, so now what we're going to do is we're going to compare, hey, if I have this money sitting in the policy, now I'm paying the payments again to myself, but I'm kind of paying back the policy that I already have. Okay? So that's what we're going to go through. Now, I'm going to mirror this payment right here now back on this illustration. Okay? And so the hard part of this is the whole life is going to not look as good because it shouldn't be showing $35,000 in interest costs. It should be saying $27,000, and so that extra $10,000 is going to make a huge difference. And so that's where I would that's again where then I can look at other illustrations and other loan rates. But I was supposed to be. I know that sometimes they're a little bit delayed, but I saw some numbers that starting December 1st, the loan rate was going to be going back to 5.5%. Today's only December 2nd, so maybe it just hasn't updated on their illustration software yet. But yeah, so 30, but it's going to make a difference. 39,912. And we are going to do that for 30 years, or as long as I can. I'm showing it in year 2, so I'm going to take this to year 31. Okay. So now the other thing that I'm not including, right, in order to do an accurate comparison is the premium. The premium I'm not assuming either in the savings. Okay, so that's like the other factor that I'm not assuming. But we're going to adjust that in a second. And when I say premium, I'm talking about these additional dollars right here. But I want to make sure that I have the loan correct first. Which it looks like so if you guys look at this, right, I'm paying this same $500,000 loan off in 14 and a half years versus 30 years with the bank. That's what this is saying. So I'm saying, okay, I took, if you do the math, right, I took $500,000 out. I immediately started paying the $39,000. So at the end of this year, my loan was $460, right? 500 minus 39,912 equals 460.88. This loan balance is sitting here. I am now going downwards, right? Paying that same monthly payment. My loan balance is oh, I'm doing this wrong. Hold on. There we go. Sorry. I was gonna say I don't think it'd be that good. It should save like 10 years. It should save like 7 to 10 years. Normally, that's with the low. That's when interest rates are loan rates are at 5%. So it's gonna be probably okay. So yeah, 25 years. Year 2 through year 27. And so if it wasn't showing this 7% loan rate, it was showing 5, which is a 20%, like think about it this way, that's a 20% reduction, give or take. It should be right around year 17 to 19 is when this, so, but still, 26 years is better than 30 years, obviously. But let's keep comparing. So, but we're going to do it I'm always the guy that'll do it by the illustration. So we're going to just export this really fast. But I will look at other companies. So that is the hard part is you have to take, what the illustration is giving you, which can be challenging sometimes. But you have to also remember that the loan rate cap is 8%. So this is like almost as high as it could get, and it's still showing better than hold on. Wait.
Hey Tyler, those
yeah.
Just to throw a huge monkey wrench in this, I'm sure you've thought about this, but another scenario you could show would be using a first lien HELOC in conjunction with whole life to buy the house.
Yeah, I just don't have that's a whole nother can of worms. Like adding that layer, because that's a variable rate, so that's also.
Yeah, but this guy's in a situation where it would probably make sense.
Yeah, but there's no way to like capture that in. I mean, yes, it's going to show that it's better than the bank, for sure, but it's not really going to illustrate the difference, in my opinion, clearly why you do that versus doing the whole life. Like taking the loan from the whole life versus taking it from the
Right,
HELOC.
right. You would start with this, yes.
It's just not coming over the way that I want it to. Okay. Did they add a column or something? Sorry guys, hold on. This is cash value. This is cash value. This is death benefit. Oh, this is from the previous thing. That's delete. Delete. This is cash value. This is dividend. Is this? Alright, I'm just making sure these numbers are right. Loan balance, loan plus withdrawal, loan plus withdrawal, loan repayment. Balance. Okay. So typically what I do is I take this number and I do 500,000 here just so it's clear. It's the only thing I alter, and then I do it 39,912 so the spreadsheet lines up. So it's a little clearer like that. That's like the only change that I usually do. So that way, loan taken. Okay, so now what we have to add though is we have to add those premiums in, and we need to make sure that this is illustration, right? So we know that this is the premium. We know that this is the loan amount is here. This is the loan repayment column. This is the loan balance column. This is the dividend, which theoretically, like high, it's not really like that relevant to this question. Okay. And hide this for now. Hide this for now. Hide this for now. And now we drag this down. Okay, so now what we have to do is so if you look, it's showing E2. E2 should be this one. So when we're looking at this from a long-term perspective, right? And we're still a little bit off is look at cash value here, right? Versus the ending account balance here versus the ending account balance here. Now I do have to add in the premium, so I'm about to do that. And then this is at like very high interest rates. So it's going to be like, and then obviously we're not talking about the shelter, the tax benefits, doing this multiple times. So like it's going to be somewhat even, but I know that if it was 5%, which I might run another carrier just to show what that would look like. So let me just add this over though. So we don't need anything here. Withdrawal amount was this plus that. Ah. Okay, and then we are no longer doing contributions starting this. All right, so now we do. All right, I'm missing something here. Okay, so now let's go run Veritas, or even One America. Because that high interest rate is really jacking everything up, I'll be honest. Whoops, that's not what I wanted.
Hey Tyler, for what about the mortgage interest? Write-off ability with that. I mean, is that fact?
I mean, that's included in the Excel.
Okay.
Down here, it's included, but it's not like much money as you would think.
Okay.
You're only saving $175,000.
Where is this something you created, or do we have access to this?
I mean, this is a company called Vertex. They give you this, and
Okay.
I've posted this a few times, but I can share it again.
I got you.
So I use this a lot just to kind of like double check math and things. This side of is like what I created is like this comparison.
Sure.
So like when you're looking at it, so we have this here. So again, being the bank, like over here, this is mortgage, right? This is being the bank traditional method. And then the last one is like the whole life, right? So like, okay, you're at, and you have to remember that like this is, I'm talking about like pure liquid. So like realistically, like if historical averages, this should probably be 3%, which is where I had it before, right? And so like, okay, yes, through the mortgage method, I'm also getting, like, let me put it here, tax, tax deduction, taxes returned, is like the term that they use, equals that number, right? So when you are talking about like, okay, I'm still further ahead using, like, financing this whole property myself, right? By like through this, through this method, right? Still, 300,000. Now, I can make a very strong argument that like I would. Oh, I'm sorry. This is the mortgage. Right. So this is the mortgage here. Oh, now I'm all confused. You guys got me all confused. Okay. Tax return here. Tax return here. Boom. Yeah. No, this is. No, I was right. Self-finance. Let me determine it's that, right? So I would think, right, that, okay, if we added these two numbers together, we're at 3.184 million versus 3.5 million, right? So in my opinion,
Taking a mortgage.
with the deductions and taking a mortgage, I would much rather have access to all this cash, right? To me, that's not enough, but everybody's different, right? So I can't tell somebody, like, they might say, well, shoot, that's 10%. I'm 10% ahead I'm more than 10% ahead through being the bank and self-financing it. And, right, the flip side is I don't have to make this payment. This is an optional payment, right? So, like, there is power in that too. So I'm comparing apples to apples right now. And that's the hardest thing, right? Is determining, and let's remove these for 2 seconds here, right? So it's really 2.2 to 2.5. So it's, let's just do the math, equals this plus this divided by 10%. Oh. So it's a 12% difference, right? So I don't know about you guys. I would lean more to the mortgage, right? And having all this access to cash for opportunities, right? But again, this guy has more money than what I'm telling you, right? He has 1.5. Number one, I know that, and I'm sure he's not telling me 100% of what he has, but just because I know him. But over here, I know I don't have a $3,000 a month payment that I have to make every month, right? Like, this is an optional contribution because my mortgage is paid off. Over here, it's a requirement because I also have the mortgage that's going. I don't know, right? That's a toss up, and I'm sure some people feel one way and other people feel another, right? So, what are your thoughts? Who asked that before? Wasn't it can't see the names. Somebody give me their thoughts. Logan, which one would you pick?
I like the liquidity. That's me. I'm with you. I value liquidity.
Okay.
Does he care about the death benefit and everything?
And keep in mind,
he does not care. Don, what about you?
That 12% difference is over 30 years, so it's not like 12% in 1 year. So it's not as dramatic of a difference as you might think.
That's correct.
It sounds like this guy's a baller and wants to do a lot more things. Hey, personally, I'm good with 12% myself, but depends, man. Depends your goals. I'm older, he's younger, so it varies, man.
Yeah. So again, you can't. Like, a valuable lesson is I'm not going to change who this guy is, and I shouldn't try to, and you guys shouldn't try to change your clients. The goal is to say, like, hey, here's leaving it in the bank, right? Now let's talk about, like, really fast. So this is like when I talk about like an email, right, version. It's like, and let's do this together. This is like, let's make this like a little bit more interactive. So when we're talking about a bank, right, what are the issues of traditional mortgages. Okay. The first one. So let's do this one. Let's do issue with liquidity. Right. And then the last one we'll do whole issues with whole life when we get to it. Issues with whole life. Right. So, and I'll start off. So, like, to me, right, and we just mentioned a couple. The issues with traditional mortgage is fixed required monthly payment, right? Heavy front-loaded interest. Heavy front-loaded interest. What else?
Did you have that illustrated, just a traditional mortgage or a 15-year, any fixed?
Yeah,
rates?
this is the 30-year. I could change it to a 15-year, but 30-year mortgage is
okay.
He's paying $700,000 in interest for a $500,000 house. Like, that's painful. But is that what you were asking?
I guess I'm trying to see if. So he's not paying the whole house off completely?
I am only showing $500,000 as like the house. Like, I know the house is worth more, but I think it's easier to show concept on a smaller scale and then have him like, all right, $1 million. Like, as long as I'm doing an apples to apples comparison, because in order to show the whole life policy front loaded with paying the entire house, then I would have to take
higher,
1.1 to 1.2 million. I'd have to have a higher, ongoing annual premium, and then I'd have to be loaning all of it out to pay for the house, right? So I would, in my personal opinion, it should be a combination for him. His name's Rustin, but I don't know if he'll listen to me. Like, I know he's interested in this because he's been hearing about it, and some of his friends have been doing it, and yada yada, and they know that it works. So I'm not like that worried. It's like a little bit warm, and I've been educating him now for a couple years because he's an existing client. But he's a numbers guy, and he's, like I said, he's quick, right? So he knows how, he's got 3 businesses. He does well. He knows how like that money game works. But yeah, all I'm doing is hey, take a mortgage, take the $750, don't touch it, and
let it grow.
And let it grow. Then this is take $500,000 out of the $750 and put the mortgage payment back into it. That's all this is. And it's a 13% difference. So that's all I'm comparing right now. So to me, when I talk to him or talk to people, right? You want to stay on track, or and so I create agendas for almost every meeting, guys. By the way, like, come in with a 1-pager. Hey, here's what we're going to talk about, right? Rattle through it, and if I know somebody's worried about term insurance, right? Like, I'll highlight the points about, okay, let's talk about term insurance. Let's talk about whatever we're supposed to be talking about, and then I'll layer in like a couple of extra things like savings path, goals, like all that, all the stuff. But at least, and then you can leave that with the client, right? I bring a copy for them. They can take notes on it. Then when they go back, they'll be like, oh yeah, remember we talked about this, we talked about that. Okay. So my issue with traditional mortgage, right? Fixed required monthly payment, heavy front-loaded issue. Issues with liquidity, right, is inflation risk. Right, we don't know what
to answer your earlier question, Tyler, there's transactional costs on the mortgage that we're not including, I assume.
Yeah. Transactional costs,
What about the time? What's the traditional time it takes to get a mortgage these days?
If you have all your documents in a row, like 6 weeks, maybe? I don't know. It took me 6 weeks, and I was not really that prepared. So, as unorganized as this guy, probably is with some existing relationship that he has with the bank. Like, if I went to go get a mortgage now, it would be a lot easier, I think.
Wait, Tyler, an entrepreneur who's organized?
Not organized, but if you have $1.5 million sitting in a bank, I think they'll say, "Oh, sure, we'll give you a mortgage."
Oh man, I have so many counterexamples to that.
So,
They're like, what?
but
No
time. I mean,
W-2 income?
I would still say time. Time is definitely, that is time of processing time, right? Time.
Time and hassle.
Yeah. Okay, and so issues with liquidity, we have inflationary risk, right? We have, what I would call interest rate risk, right? Meaning, and what I typically do, right, is like money market rates in 2016, right? So look at this. The money market average was 0.17 with a bank with a credit union, and banks was 0.12. Okay, 1 year CDs was 0.37, right? And so money market rates average in the last 30 years. Okay, so let's do that. 1954 to was 4 point, but look at that. We'll never see 16 since 2000. Right, so 2000 to 2004 was 1%. I'm sure I could find it if I looked, but when I've looked in the past, if I remember correctly, the average is like 1.8, right? And so I'm showing everything that I'm showing on this Excel is 3% because I'm trying to make it like close to what it is today, but I don't know what the next 30 years are going to be, right? So that's just another little note, right? So, 2016 rates were less than 1%, right? So these are things that are out of your control. So what else is the issue with liquidity? Any other issues that anybody can think of?
Well, you always have. Do you trust the banks holding up versus your insurance company?
Bank risk. I think the FDIC insured. Bank risk and stability. That's an excellent one. So I think that's probably pretty good, right? Keep it short and sweet. But if anybody has any others, I'm all ears. I'm sure there's more. Right, guys? I'm not saying that this is it.
Tyler, you mentioned he had $5 million in term, so he obviously wants insurance.
He's not gonna
or something.
Yeah, he's not gonna cancel that term.
Right, but why does he have $5 million? Does he have kids?
Yeah, but he's one of these guys. Like, I'm sure you know him. Like, they'll be fine with $5 million.
Right. Yeah. I get that too, but obviously, the guy's got a 98% chance that's going to be gone anyways, that term. So, the benefit of with the whole.
Oh yeah, we haven't gotten.
At least you got more term.
We haven't gotten to the benefits of whole life yet. Yeah, you're absolutely right. So he knows. He's starting to see like, hey, I'm going to outlive this term, right? We're 7 years in now. He's worth more now than he was when he got it. He sees the writing on the wall, right? The question is do you go? His question, right, is, do I go the traditional method of what his other financial advisors are telling him of buy GUL, right, buy this, buy that, max death benefit, least costs, and invest all of your other money? Or do I go this IBC, get a bunch of money into this policy and let it grow, that way? So that's kind of what he's fighting right now, internally, right?
Does he has another financial advisor, Tyler? Is that what you said? Or are you just mean in general?
He's got a money manager.
Ah, okay.
Yeah. So
that's always fun. Yeah.
Yeah, I mean, my team does some of that stuff, but I'm not sure this is the guy that I would want to to manage his money. He's kind of a pain.
You know what's crazy to me that it's never talked about? What it must feel like the day when your term insurance drops off. And I don't care who we are. At the end of the day, when this guy's $5 million term drops off, it couldn't feel good, you know?
No, it doesn't.
And across, it's just across the board. I've never heard that discussion come up once. You know?
Yeah, so that's a good point. So, you know, Carol, who's this guy, you know, she's older. So, and Dan, some of you have met, you know, they're in their 60s, right? So all their clients are in their 60s. So, like, when they renewed their client's term when they were in their 40s, right? So, like, the most common kind of, like, practice, guys, and I'm not saying this is wrong, and it should be done, right, is you have a young guy like me, 32 years old, you know, young kid, probably going to have another kid. I cannot afford the amount of whole life right now that I would want to replace in death benefit if something were to happen to me, right? So I believe in the combination method, right? As much term as I need to make sure my wife's taken care of. Whole life is going to be the long-term play, right? It's not a short. Whole life's never meant to be a short term. But let's walk through this, right? If I was doing traditional only, so let's just say I was the average Joe, right? Didn't have any whole life. I'm 30 years old, have my first kid. I buy a 20-year term, right? Most of the time people don't buy that, right? Because they're so on budget. You'll see people buying annual renewable term, or you'll see a 10-year term, or you'll see a 15-year term. I see that more than anything. But let's just say they're at least somewhat smart, and they say, okay, they have a good insurance person back when they bought it, and that insurance person says, okay, Layla's one, you need at least 20 years, Tyler. Get her at least out of high school. Like, okay, right? And so you say, okay, your income is $100,000, 20 times your income. You need $2 million. Now, the problem with that shortfall is, okay, Tyler, you're making $100,000 now, but in 5 years you're going to be making $150,000, right? And so do you try to account for that increase in income now, or do you go in a few years and try to layer more insurance, yada, 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 right? So let's just say client says, hey, $1 million is in my price. Okay, well, now I'm 50, right? And meanwhile, I've had 2 other kids, right? And maybe I haven't been as good at adding, more insurance as I've had more kids, right? But now I'm 50. Layla's 20 years old, and I know some of you are older that have older kids, but I look at Carol, my mentor, I look at Dan, my mentor, and I look at like 30 to 50 clients that are all in their 50s now. Kids are going off to college. They still need a bunch of insurance. They haven't saved enough for retirement, right? They still have a mortgage. The spouse still depends on their income. Their kids still aren't off payroll. You know, they're going to lose one of their spouse's Social Security check, right? And so now you're 50, right? So if they would have bought whole life in their 30s, right, they would have been way better off. But now they're in their 50s. So now you have, do I buy a 10-year term to get me to 60 so it's not crazy expensive? Do I buy a 15-year term, or do I go 20-year term and get myself to 70, right? I have had more clients this year that are 69 years old that have said, Tyler, is there any that are not healthy anymore, right? And when I say not healthy, like, they could probably get approved, but it wouldn't be pretty. It would be table C rated, table, B rated, compared to their preferred health ratings when they were 50, right? They're all like, how can we extend this, right? We'll pay whatever we need to extend it at least 10 more years. We really want to get to 80. We really want to get to X. We really want to get to a certain age. That's why I wrote so many GULs, because all those cheap terms that Carol and Dan, again, guys, I'm learning from 20 years of their mistakes, right? We're doing more GUL this year than I've ever done, because the Transamerica terms, they're protective, the Western and Southern, where it used to be a huge term player back in the day, that protective bought that block of business from them years and years and years ago. The only thing is a GUL, right? And it's still convertibles, right? That's the only time to convert. And these clients are paying it because they realize, oh shit, I need insurance at least for 10 more years. So I 100% agree with you that like term is definitely not term. Most of the old term policies are convertible to GUL. Most of them are. And then the other opportunity I've seen more this year is people that have term that can't afford the convertibility, that are unhealthy, and that's where the life settlements are. That's like that window. So I've been seeing all these people that are, because Carol's 70, Dan is 60. I see a lot of like they're all of their clients are somewhere between 60 and 80. So I'm seeing all these people that are like, you know, with their kids and you know, and it's a problem, right? So I 100% agree with you, Dom, that that's a conversation to be had. It's not an easy conversation to have, right? Because I wish, like, even I talked to my brother-in-law who just had his second kid, and he's like, I'm not buying whole life, Tyler. I'm going to buy a term. I'm like, you're an idiot. Like, I just straight up tell him, I'm like, why aren't you going to just trust me? Just trust me. He's like, I can't afford it. I'm like, dude, you just spent $3,000 going to Disney for the second time this year. Like, what are you doing? You know? So, I get it. So, again, it's not an easy conversation, is what I'm saying. But you really are doing them in the, yeah, that's true. Family members are the worst prospects. I gave him some term insurance that's convertible, and I said, we'll continue this conversation in a couple of years, is what I told him. So, but at least he's protected, and I won't feel guilty if something happens to him. So, so that's kind of that. So I know we're kind of running over time. Maybe we'll finish this next week because I don't really have to get this to him. Or what I'll do is I'll finish it up this week, and next week I'll show you guys what I presented to him. I doubt I pin him down this week to get to him anyways from the holidays, but you guys can kind of see how you like summarize this for a client that like wants to like, hey, you know, give it to me straight and walk me through it, right? And so now the question is I gotta, number one, talk with Lafayette, and number two, because this 7% interest is killing this projection, it would look very attractive if that wasn't in there. And obviously, you know, I can tell you, like, I can illustrate it at 2%, and but he's going to be like, I'm earning 4, you know, show me 4. So I got to make sure that I'm ready for that counter argument type of thing. So yeah, I'll what I usually do is I play with a couple of illustrations here, and then populate them over so I can hide them, and then from there it's really like what you guys are seeing. I bullet point through, like I can get his sense, and I've already done this, but I reiterate, hey, like, how do you feel about a fixed required monthly payment? He's gonna be like, it doesn't bother me as long as it's under $4,000 a month, or as long as it's under a certain number, right? Hey, have you ever heard, like Logan was saying, hey, have you ever heard of the cash value line of credit, or first position HELOC, or the all-in-one, like whatever, you know, all those big ticket terms. And he might say, oh no, I haven't, and I might set it up as in like, hey, that's number 2 of this process, right? Like, let's do it this first. Let's do that second to make sure I secure the sale. You know, how do you feel about paying all that interest up front? How do you feel about the transaction cost? How do you feel about the hassle of dealing with the bank? That's a big one. You know, how do you think inflation's going to be handled? Interest rate risk, right? Bank stability. You know, the other one is so that's kind of that, right? And then we go through the negatives of whole life, and then we go through the positives, right? And so you kind of like, hey, right here, whole life, you don't have to pay it, right? You can let the interest accrue, you can make the payment, you can own. So you have the flexibility. Awesome. Hey, interest is not on an amortized schedule. It's a fixed interest calculated daily. Boom. So, all right, 2 points to whole life. Transactional cost. There is no transactional cost. You have a 48-hour leeway. So, compared to having to bank in cash, yes, slightly longer, right? But not much. Time and hassle. That's what you have me for. You're either going to go online and do it like a wire, or you're going to reach out to me, right? So you can see how I can go through all of these points and immediately start like positioning, hey, whole life is going to solve this problem in this way, right? And so that's kind of what I do throughout the meeting. So by the time I'm getting to the concept, he's already kind of sold, and then he sees the numbers, and they reinforce everything that I just said. And hey, let's get into underwriting. I think that's, for him, that's going to be the hardest part because of his industry past. I'm hoping it doesn't come up. But with my luck, it will. It's usually how it rolls. So I have a guy right now. You guys will get a kick out of this in the story. So he got approved with, his wife and him got approved with Lafayette. But I wrote the wife, right? Large premiums. But they said, hey, we don't think their income is enough for both of them to do the same size policy, right? Because each one was, they were front loading $200,000 into each one, and then they wanted to do $60,000 a year each, and their tax returns only show like $300,000. So they're like, hey, that's more than 50% of their income. Meanwhile, she's hard money lender, all this stuff, right? So I know, Kathy. I fight with. This is the reason why I'm in a bad mood. So, Lafayette though had him approved at preferred non-tobacco. So I say, all right, let me send it to Emeritus, right? So I do it 100. I do the app to Emeritus, send them everything that I already had, right? I was like, hey, he's already approved here. Yada, yada, yada. They look at his records, right? And the doctor has his records marked in 2023 that he's an everyday smoker. And the client hasn't smoked in like 20 years. His 2020 records show that he's never been a smoker, and his 2024 records show that he's not a smoker, right? But of course, it shows January it shows December of 2023, so his year of like non-smoking. And so now I'm fighting. I'm like, clearly this is an error in the doctor, right? The doctor's records. And now I'm like fighting with him to be like, come on, like he came back non-smoker. His blood and urine was clean. Like clearly it's this 1 year that shows that he's a smoker, but he hasn't, like, even if so, like he hasn't smoked, yada yada. And it's like I'm just like baffled. And now they're like, oh, the only way we'll give him the non-smoker rating is if they amend his doctor records with a letter. And the client is like pretty proactive, and they kind of pissed him off that that's in the doctor records in the first place. So like that helped me. But now their insurance doesn't cover that doctor. And so now it's just like I'm like just shaking my head. So we'll see. That's how my Monday started. But so that's kind of so next week we'll see this final thing for this, and then I also have a really cool IUL audit that I'm doing with this attorney that I don't know if you guys have seen Chris's videos. So I did a deep dive into this case. He asked me to help him. So I'll show you what the attorney's perspective of like what he asked me to look at specifically for the trial that he's coming up with. So I'm not gonna be able to share like names and stuff, but I can show the illustration and kind of what that looks like. So, any other questions?
Yeah,
go ahead.
What's your take on the numbers? I know we're always taught, hey, it's not about the numbers, right? All the other benefits and stuff. But the bottom line is, for some clients, and especially, your more wealthy clients, it's all about the numbers to them.
All about, oh, for sure.
So, in terms of training, and it takes, you're outstanding with Excel, and put it in. But in terms of, as a strategy at Life 180, helping people understand and how to formulate the numbers, starting basic and moving out to deal with clients like that. I mean, we can always turn to you, but as we, at some point, we got to become independent. You know what I'm saying?
Yeah, so we are working on some software, like calculators that only available to you guys. Basically, like these custom Excels that you can kind of like plug in the scenarios, right? And so it'll probably start simple on more like a car loan or like a traditional, mortgage versus, not, kind of like very general examples. I mean, when I say general, I don't mean like you can customize all the numbers, but I would consider this one to be a pretty advanced, specific scenario of comparing 3 or 4 different things, right? The problem that is with these calculators and the Excel is, you're absolutely right, is I'm still basing everything off of an illustration, right? And the illustration isn't so much a realistic outcome, right? It's just a projection, right? And so the question is like, okay, if I'm showing this moderate conservative projection on this illustration, right, I then have to say, hey, like, I can't assume that, I have to assume modest or average projections on all these other sides, right? Like, people can't be naive to think that, like, hey, if interest rates come back down, that we're going to still have money markets paying 5%, right? Or 4%, right? They're going to go back into the 2% range, right? As whatever policies change in the government, right? Like, those things are going to, so like, you have to be realistic in that output. Now, when it comes to the numbers, right, that's why, like, a simple thing like Lafayette adjusting their loan rate, and I had a big, long conversation with the vice president, which we can certainly talk about next week about it, because I was pissed when I got that notice. It was only for 2 months, right? But you can see how much it jacks the numbers up, because I deal with a lot of engineers, I deal with a lot of numbers-driven individuals, and you're 100% right. The numbers do matter, right? And so that's why I said, all right, well, I'll have to go look at Emeritus, I'll have to look at One America, right? Because ultimately, they're still buying off of that sheet of paper for some people of like what that illustration is projecting. It's up to my job to say, hey, like, this is a snippet. Like, I know this illustration doesn't illustrate as well, but like, look at the historical performance of a Lafayette versus One America. That's where I can overcome that illustration shortfall, right? But you have to be able to show, like, hey, this is like what it could look like, right? And so I go to like a Mass, if I'm really struggling for numbers, like, you go to Guardian, you go to Mass, and then you pivot back to Lafayette and be like, hey, like, here's what the numbers could look like, but I show Lafayette because of XYZ, 1, 2, 3, 4, 5, and this is why it's not illustrating as well. And then I can show, like, hey, here's what all their loan rates were, right, for the past 2 years. Like, see this little blip of 2 months. People are like, oh, okay, like, that makes sense. So, but when it comes to like showing these detailed things, you're absolutely right. So, by next week, I'll have an answer from them, because I know that sometimes it's delayed in reflecting in their illustrations. But like, let me see if I can find it really fast, actually.
So every time you're putting through a policy or getting close or going to talk with a client, you kind of got to call and let them know they change it that often?
Lafayette sends you a notice, and then when the client goes to request it, they let them know. Like, it's listed on the client side. But if you look at like all of the carriers are adjusting it all the time if you look. Like they're all adjusting like monthly, right? However, I will say Lafayette does not a great job at like communicating those changes unless you ask for it. Compared to some, they Guardian is fixed, so you kind of know what there's going to be. Like Mass puts it in their illustration software. One America posts it pretty regularly, like on their dashboard page, and so does Emeritus. But what I will say is, hold on, I'm trying to show you so that way you can kind of see what it looks like. But I think I got so pissed off.
Yeah, that would make sense. Like this, they have on their page like freaking gasoline prices. If police on the board every day, you could check it out. And then once you're locked in, that's good for a year, and then
that's good
every year. Is that correct?
Yeah, that's good for a year. I mean, that's why like I don't necessarily pay attention because unless a client is going to be using it, right? Like right away.
Right.
It's like tough to be like, hey, like, all right, I think I found it here. Because I think this is back in September. No, where'd it go? Problem is, like, I searched loan interest, and it's like, I have a lot of clients that have loans outstanding, so it's like I get a ton of stuff. But if you look at it, like every carrier was at like 5.2 last year. I should find it here in a second. And then Lafayette was at 5, right? And then you saw them increase like it slightly. So they have two ways that they do their loans. So basically the reasoning was they had so many people that did loans this year, like within 90 days of purchasing the policy, that they had to change their reserves in their company to make sure to like account for it, right? So they weren't expecting it to happen that fast or to have that big of a volume of people doing it. And so they said, okay, how can we prep, how can we account for this, right? What can we do? And so they announced that loan increase. And then, of course, 2 weeks later, then the Fed lowered rates. Well, they had already announced their rate increase, so they kind of shot themselves in the foot there. And then, so when I talked to the VP, he's like, hey, like, we had so many people taking policies. So when you first get your policy with Lafayette, right, the first year actually doesn't matter when. Gosh, I keep seeing it. It's right here, but it's not. So like the first year with Lafayette, right? Whenever you're I know exactly what it looks like. So like the first year when you buy your policy, right? It's the month that your policy is dated, right? So that way like, hey, for this year, if I take a loan, whether I take it in October, it's fixed for that year. That's the number that they changed. Okay? They have two kind of loans. It's their first year loan, and then it's their cyclical, hey, this is the month, this is what it is. And so they crack down for that first time month, which is why that's what's illustrating, because it's on new policies only, not on in-force stuff, right? So like next year, if I had a client that had a year 2 and it was September, it's like at 5.5, which which is why I keep saying 5.5. So it's just that first year thing. So I'll get the clarification done, and I'll post it in Discord when I find it, just so you guys can kind of see, because you'll see that it hasn't really. It's kind of like this outlier thing, and I think they had like a knee-jerk reaction to a bunch of things going on politically. Like if you look at the time of when they announce it, and I think they just missed the ball, and I saw that it was supposed to be coming back down already. And then Tara, if you're still in here, so I'm making the announcement this week. I'm finishing up this website for everybody, and I'm probably going to start it January 1, so that way everybody is like, it's like a fresh start to the year. Chris is coming into town next week. We're going to film some free stuff for it, so keep an eye out. It is coming up. I'll give you guys like a quick sneak peek for those who waited or stayed on here. And this is going to be included. So if you're grandfathered in with the pricing, I'll be curious on a little bit of feedback. So this is all included. You'll part of it is like kind of setting up your page. Oh, Clark was in here. I can always tell. So you'd put your photo in here, right? You got to clean that up just slightly, right? So this is like your page, right? You'll have all of these links will work specifically for you. These services you can adjust. We show you how to like adjust them if you, like, for example, if you don't do velocity banking kind of thing, right? So all of these links will work, but the big thing that we've been adding is these resources. So these master classes will be allowed. You'll have links as well as this website where people will be able to watch them, and then you can track their progress throughout the whole. If they watch it, if they don't watch it, it'll alert you. There's automatic drip sequences that it looks like it's coming from you. And then so we also have the cash flow hacking book and the What Would the Rockefeller book with like a course. So all of those things you'll be able to track directly. Hey, this, whether you send them the link and they click on it, or if somebody just stumbles across your website and clicks on these links. So that's what we're just tightening up slightly, making sure all the links work. And then there's also a retirement checklist quiz that you can send to clients. I think it's really great for clients that are within 5 years of retiring, that I use for almost every pre-retiree. So those are why we're a little behind. And then the About Me page, you'll upload photos of yourself. And on the training, you'll see like what I did, and they cycle. This is just the preview. But, so yeah. So, but, yeah. So we're getting close.
Did it have some on trusts there too? In that last, back in the resources? I saw where it had.
Yeah, there's the What Would the Rockefeller is ultra wealthy, you know, the secrets of doing the dynasty trust, basically.
Yeah, and the part where you showed the velocity banking as one strategy, I forgot what it was. Oh, services. Is there a trust information in that one? Is that part two?
Legacy and estate planning.
Oh, yeah,
I just
perfect,
haven't.
Yeah.
I haven't done the subtext yet for these sections.
Okay,
so.
Cool. Yeah. That's where
yeah, so
slacks, man. Everybody slacks in the trust.
Yeah, so we're going to be part of the. There's going to be 2 weeks of trust training. There's a couple of ways that we've mentioned a couple of them, but we're going to get into more detail on 2 of the weeks of the training on basics versus like advanced versus like what would the Rockefeller do method. So we'll get there. So yeah, we're getting close. I know I've been saying that, but all of these courses are filmed and updated. Now it's just making it so it shows up in your system as yours, not ours, which has been the problem. All right. So we'll see you guys next week. Hope everyone had a good Thanksgiving. And if you guys have any questions, reach out to me in Discord and keep an ear out. And when I find that loan rate sheet, or when they email me the new one, which they should today, I'll post it in the Discord so you guys can see it.
Buddy. Thanks, man.
All right, guys. We'll see you later.
Thanks, Tyler.
Jesus.